Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, January 23rd, 2026. It's 11:02 a.m. Eastern Time, so I'm starting the video. It won't be a super long one. Here's what I want to cover in this one. I'll try to keep it in this order in case you want to skip ahead to a certain section. As usual, I'll start out with the equity markets. Brief overview. I've been getting a lot of posts out, a lot of little nuances, levels, and potential developments I'm watching for. So I think if you've been following me, you know my thoughts pretty clear on where we're at. And also, I cannot impress this fact strong enough. We continue to be in a sideways market, as evidenced by, well, it's evidenced by the charts. We've gone nowhere since, up and down, back and forth since really about early September there. That's where I have that purple box on QQQ. As such, if you are frustrated, which you probably are, unless you're very adept at trading intraday charts, day trading, and you can make money long, short, long, short, long, short, and trading range. But other than that, swing trend trading, you're going nowhere, you're spinning your wheels. And so I will just continue to reiterate, my strong preference of individual security selection, long, short, the most bullish and bearish setups, be they individual stocks, sectors, commodities, crypto, treasury bonds, corporate bonds, whatever the asset class is. All right, so let's move on. A quick update here. Here's, we do have a potential downtrend line. It's not super well defined, as I mentioned. Probably be bullish if we took that out and increase the odds that QQQ might want to punch, try to make new highs. Still not my preferred scenario, but as always, I'm open to anything. And so what we have more recently are sell signals with the break of the uptrend line wedge. Remember, there was also a divergent high right there. This was a rising wedge pattern. You had slightly higher highs on this period right here with the lower highs in the indicators. So clear negative divergence and the sell signal that came and nothing but pretty much a back test so far. Let's drop down to those 60-minute charts. As I stated recently, my preference as far as index shorts was to up to the gaps, but not above. SPY just hit the gap. I'm talking about the gaps that we had on Tuesday. Remember, markets were closed Monday. We gapped down Tuesday. The media, as I've always promised you, I've done this long enough. They will cite a headline, and look, you can definitely use the Greenland thing if you want, but the media will assign a headline whether it makes sense or not for any big move in the market. And these moves were technically induced. We were coming off multiple sell signals on the shorter term time frames. 1, 2, 3 back tests there. So breakdown of the minor trend line, breakdown of the more significant uptrend line, back test, divergent high, and that's it. So say what you want about it. Hit my 607 support, bounced. And here we are right now. We are back testing the uptrend line right now. So that still keeps this sell signal very much intact. And I still expect more downside, at least down to this level here as the arrows have drawn. Nothing has changed there, but it could. And that's why I do these videos. We start to take back, levels, resistance levels and trend line levels, trend lines and other things that were broken and key moving averages. And that changes the technicals and it'll change my view. There's the gap on the S&P 500, and so far it's stopped cold. It's like a wall for the S&P 500. Now we're only talking a few days. Those gap downs occurred on Tuesday, but so far every single day here since we got back up there with the what I call the Trump hard taco trade, we all knew it's just almost a certainty. The market's just now. And the funny thing is, I'm surprised they even reacted to the downside. So you listen to the media, and they were reacting to Trump's supposed tariffs that were going to kick on Europe, 10 and then ramp it up to 25. Everybody, including Europe, knew that wasn't going to happen. He talks the tough talk, he asks for the world, and then he gets a little sliver of it. And then, at the end of the day, I have to say it's a successful negotiating strategy. If you benchmark him on what he says, I will take nothing less than owning Greenland outright, the U.S. owning Greenland. Military invasions is definitely on the table. So that's rhetoric. And again, whatever, we'll see what the nuances of the deal is. So my point is, this whole snapback rally shouldn't have been any big surprise. But again, to me, it was all technically induced. And I always say that, the news and the technicals do align. guys, don't get me wrong. The technicals don't happen in a vacuum. So what happens is you have bullish and bearish setups in the market, be it bullish and bearish chart formations, support levels, whether it's a key moving average or a price level or a trend line, and then quite often it is a fundamental catalyst that finally helps trigger that or aligns with it. So they're very much intertwined, but there are many times where I've seen a technical breakout with absolutely no reasonable headline. Like I said, the media, it's laughable, will scramble to assign a headline because their job is they can't just, the writers can't come out and say, we have no idea why the Dow fell, 500 points today. They don't say that. They're going to recycle a recent headline or a reason, even if it, in many cases, it's funny because I've seen the opposite reason. The same headline they assigned for a bearish move was one few weeks earlier they've assigned to a bullish move, be it sentiment or, you fill in the blank. All right, let's just move on. Levels are level. That's all we can do. The news is going to, come out every day. There's always going to be a reason, a bearish. Again, in a bull market, good news is taken as good news. Bad news is typically either shrugged off completely and ignored or spun around as in some way or another bearish. I'm sorry, bullish. For example, a bad jobs number will be spun if the market wants to rally because of the fundamentals or the bids are there. There's more buyers than sellers, and and you're in a bullish moment. They will spin a big spike in unemployment or something like that as a net positive, even though it's shitty for the economy and it should be for the market, but it increases the odds of a rate cut from the Fed, right? So there's one of many examples right there. So, all right, I'm just trying to say, and I'm going to get to that in a second. I'm going to show you with a recent trade, a news headline, and how you, again, if you're trading off the news, you are literally, to me, it's like driving, your car looking in the rearview mirror, just you're going backwards. You're trading on things that have either fully or mostly already been priced into the markets, or by the time you read about it, it's too late. It's out there, and the markets have instantly reacted to it. So that's that. We'll get to that in a second. So that's it. I just want to point out that the S&P 500 is still at that level there. Let's talk smallies. Because I did give you a new trade idea. Sell signals recently triggered on the small caps right here on the break of this minor trend line. And we went on, made a marginal new divergent high. I updated this yesterday for y'all, so that's still within a reasonable risk-reward ratio of that fourth target. And again, these are just near-term targets. That's all I'm throwing out or focusing on at this point in time on QQQ and SPY. There's another trend line now that comes into play right there that would trigger the next sell signal. But let's not forget how the daily charts look. Breakdown right here, primary uptrend line back test, second day of back testing followed by a rejection. Me, it's the rejection I like to see, because the problem on back tests, and especially if you're shorting a back test after a breakdown, is you can keep back testing and then you're going underwater, or you can keep back testing and finally recover that line. But so there's an impulsive rejection. And again, the weekly charts haven't changed. We just have big divergences. And this breakout is most likely to fail because it has overbought conditions with negative divergence. And those type of breakouts, 9 times, if not 99 out of 100, will fail. So let's just see what happens there. Let's move on to the futures. Let's do that real quick. So NQ, we did pop that downtrend line I gave you yesterday right here, a little minor downtrend line. That was popped. That's given us this near-term lift right here. We are coming off, the most recent divergent low, positive AK bullish divergence. This is your swing trading time frame. But remember, it's all within a larger sideways range. You're looking here. This is a 3-month chart with 60-minute candles, as you can see. And, we're kind of wedging. You can maybe tweak out that downtrend line right now if you want to do that. Either way, it's a relatively soppy range, but the one consistent thing in here, you look at these divergent highs and you followed by drops, divergent lows followed by rallies, divergent high, divergent low, divergent low, divergent high. And I just have to borrow one of these I'll borrow you, copy commentary, cut, paste, wash, rinse, repeat. But you can see here that these ranges off these divergent highs and lows really are getting smaller. You're getting price compression here. And this trading range, sooner than later, is going to break one way or the other. You guys know which way I think it's going to break, but I'm not married to anything. React if it breaks the other way, meaning to the upside. So that's kind of the sloppy, if you will, for not lack of a better word. It's a pretty good word to describe the recent trading range in NQ. ES, the S&P 500 futures. I've got you somewhere here. Bear with me, guys. I've got a lot of charts, as I covered in yesterday's videos down below. There it is. ES, you can see, there's the gap from last week's trading where we closed Friday, opened up the Sunday evening trading. And so it's basically just like on the S&P 500 or SPY. I'm sorry, this is the S&P 500 futures, ES, 3-month chart. And so far, that's it. That's stopped this rally cold. And so what I'm seeing is a slight little baton handing back to the big tech stocks. But the case I made, like today, in my opinion, and it was highlighted in advance, it's almost all Microsoft. I'm going to get to that in 1 second. But and what I am seeing, as I've told you, I'm waiting to see the financial, or I was waiting to see the financials start to weaken because they have been almost single-handedly lifting the broad market, the S&P, and citing the narrative that the Wall Street's using, which I fully recognize, sector rotation. But again, from my experience, when the big tech stocks take a breather, sometimes it is healthy consolidation. They're a little overbought. They consolidate or correct for a little bit while the rest of the market comes up. And that can support the case for new highs. I completely recognize that narrative. I've seen it before. Then there's that other thing that I've talked about where you can get that type of breadth spreading out, market breadth, different other sectors of the market starting to perform. And it's that what's known as terminal lucidity is that medical term I gave you, where a terminal patient, it's really been going downhill. The end is near. Everyone knows it. They're on pretty much final stages and, in hospice or whatever. But then they have that moment of, they call it again, terminal lucidity, where they're all of a sudden they're very lucid. You have a good conversation, everything's well, and then boom, that's it. They pass away right after. And I've seen that many times in the market. And again, if the market leading magates can pick that baton back up and run with financials holding up relatively well, it doesn't mean the financials have to run lockstep with them. They just can't drop hard. Then, that makes a case for new highs. It's not the case I see right now. I see that terminal lucidity signs of the market. I've seen it before. And again, that's why I do these long-winded videos, show you all the levels to watch and support my case. All you have to do is turn on the TV on any channel, Bloomberg, CNBC, pick up the media, and you'll get, the other case from 9 out of 10 or more pundits. So I don't need to sit here and make the bullish case, but I do. I tell you what needs to change. For example, that's what I did this morning. If we start to undo some of those sell signals, I've given you the check marks on the magates, each and every one, if it gets undone, if Tesla takes back its trend line, if Alphabet takes back the trend line, both of those broke down this week, giving me additional check marks. Well, that undoes those check marks. And at the end of the day, if you're like, well, Randy, you're just too nitty, too gritty, too precise on this. This is what happens in a trading range. You tend to get these whipsaws. But I'm building evidence, and I'm doing it very, very methodical, strategic. I have those levels I'm watching. And again, it's I always use the analogy of a criminal defendant case. In a court of law, the prosecution must prove beyond a reasonable shadow of a doubt that the defendant is guilty, because the innocent and proven guilty, innocent otherwise unless proven guilty, right? That's the U.S. legal system. Well, in a bull trend, especially a very resilient one, you better have a good case to short pretty strong. And I've made very, very clear it's not been an all-in moment on the short side for a long time, but it has been a scale-in moment, waiting for some additional sell signals to build to a larger full position there. all the while trading the best looking stocks, sectors, commodities on the long side or the short side. So I'm going to move on. I'm going to get to some hedging options for you in a second, some other things. So let's, before I get to the financials, let me just cover the smallies and the futures for you futures traders. This is the daily chart of RTY. Big divergent high. There's that breakdown and back. I just showed you the same thing on IWM, which is the ETF. You have your divergence, negative divergence, recent sell signal there. And if I step it down somewhere, I believe I have, I'll just do it on this one. I have a hourly chart. Nope. It depends on which chart I do the annotation. So let me return that back to the daily time frame. Let me pause the video and find my 60-minute chart. There we go. Okay. So that's a divergent high. See our negative divergence right here, building over this time period, just like we had right here. Same kind of divergence. There was a correction. That correction took us back to this trend line. That is a longer term, more significant trend line that goes way back to the left of this chart. And the next sell signal comes. We already had one here. There was our uptrend line, breakdown, back test, followed by, you got it, what I like to see, an impulsive rejection. So the next step to give me additional check mark here is a break of this trend line, then a break of 2632 support, and then you see my price targets. Each of these support levels would be on the downside. All right, so what's going to be the catalyst for that? We're right now having the January effect, which is a well-known, well-documented thing. The small caps tend to have a bullish seasonality in the month of January. We're going to move on to interest rates. We're going to look at bonds, but first, as I said, financials. Okay, so this, I think, as much as I've been hyper-focused on the Mag 8 lately, getting you a lot of updates on those, a lot of charts, a lot of very precise levels to watch. Again, it's not in many of those, it's not a single level. You have, multiple support levels, and then what I've given you is kind of my lights out levels. Well, on the financials, which again, no one can argue because it is the second largest sector in the S&P 500, they've helped that outperformance recently of the S&P 500 over the tech-heavy NASDAQ 100. I mention this often, but the NASDAQ 100 has very little, if any, weighting of financials. It's pretty much the one sector that's lacking, and it so happens to be the second largest sector of the S&P 500. So that's where you get the divergence and outperformance. And typically the only time I'm going to trade the S&P 500 futures over the NASDAQ futures is when I think there's going to be a big move in the financials that way. Otherwise, 99% of the time out of 100, the NASDAQ 100 is going in the same direction as the broad market, the S&P 500. It's just going up more in percentage terms in a bull run and down more in percentage terms. So my theory is, or logic is, I'm either going to be right or wrong on that call. I might as well get paid for it, right? If I'm going to put up my money, let's go with the one that's going to pay me a little better returns for taking the risk. All right, so XLF, to recap, when we were back here, we had a breakout back test, that second back test, and I said I wanted to see and was expecting this breakout to fail because of the technical conditions, negative divergence, overbought conditions. This is overbought on the RSI. Big divergence has been building for many months, and so that was a check mark. It failed. It also failed. We had a little bear flag there, but let's talk more about the failure. I mean, bear flags they pop up quite often. Sometimes they play out, sometimes they don't. But I gave you a check mark recently with the failure. And then, okay, so if I thought this was a significant level, which I did when I was covering it when we were up here, the fact that we back tested it and then failed, once you took it out, remember, when you're above a level like that, it's support. Support once broken becomes resistance. The fact that on the back test we got rejected, that helps to validate that as a significant resistance level, and it helps to validate the fact that the breakout has failed. Now, to take it a step further, again, these things are not always black and white, and that's simple. I said very often when something breaks out to a new high, it'll come in and back test, and the powers that be will take it down below a perfect back test. A perfect back test is almost too easy. So quite often, again, whether it's nefarious forces in the market like the algos and the trading desks and market makers, I know there's part of that in there, undoubtedly. or just the way the markets work, it's not unusual to see a back test come back in. And it's actually pretty bullish if it does. Why? Because what it does, it blows out the stops of the weak-handed longs. Those that bought the breakout and put their stop right below it, they're blown out. And they're what I call weak-handed longs. You have weak-handed longs and then iron fists, people that are going to hold no matter what, right? Or at least through a bigger drop than that. It also is what we call a bear trap. It sucks in short sellers that might jump the gun and saying, oh, wow, that breakout failed. We're going to go down now like this. Well, and maybe they're right. Again, I'm acknowledging I was looking for it, expecting it's happened. I'm going to take it on face value at this time. But, what happens to them, if they shorted the failure of the breakout, the logic for that entry on that trade, that short entry was a fall back below 54.50, right? So therefore, logically, their stop should be somewhat above there, because if you get back above, especially if you pop that high, you're going to take off, right? So then they get stopped out. Remember, when a short seller gets stopped out or takes a profit, anytime they close out their short position, they are buying the stock. That is what a short does. You sell it first. You're selling shares you don't own. You're borrowing them from somebody else. You're borrowing from your broker who's taking them out of someone else's account, giving them to you, saying, okay, we're gonna let you sell it first, and then you got to buy it back at some point. So that's what happens. And my point is that's buying pressure. And so that's what makes that very bullish. If you can pop back up there, the shorts start to cover, more longs will jump in, saying, oh, well, guess what? We did that. It was just a slight undercut of the back test. All right, so enough on that. Again, these are little micro levels. These are things I watch every day. But now, like I've been saying, even before this breakout failed, I'd really like to see it get below this level and then the 200s. These are the big ones. And so what happened? We hit that level, which again I had it in advance, 53.10. That level was created back on September 4th. All right, so months ago, over a quarter ago, hit it perfectly, bounced, we're at it again. So when that breaks, the next and a very big support level are the key 200-day moving averages. And if and when those go, this is kind of what I call a BOD. It's 200 is taken out. It's nothing but a bearish technical event unless they are recovered. But a break below 51 really gets you away from there and takes out the bottom of this multi-month trading range. Really was right here. We were in that multi-month trading range. We had a breakout which failed, put us back into the range. From my experience, when you have a trading range, if you have a failed breakout, be it to the up or downside, if it fails and you re-enter, you'll hiccup on the midpoint. That's why I had the midpoint line. And if that breaks, then you're probably going down. The simple fact that we re-enter the trading range, in my opinion, increases the odds we're going to go to the bottom, because that's from my experience. And then down through. That's exactly what happened to the stock market back. Last time it had a major top back here. Same thing. Again, I've walked you through this one day by day. We've had the false breakout, expected to fail, called for move down to the bottom and then down through below. And that's exactly what happened right there. So same thing here. And that's why SPY looks a lot like XLF. It's not by mere coincidence. Again, it's because XLF is the second largest sector in the S&P 500. So it has failed. Tech has yet to break out. Now, if tech breaks out and takes the baton, great. Because tech has twice the weighting, even though it's the XLF is the second largest component. It only weights in at 13.68, 14% of the S&P 500, where the tech sector accounts for XLK, if I can, accounts for over 33% weighting. So there it is, guys. I know I'm getting very nitty gritty, but we're gonna get in front of this thing, and profit from it. And there's by the way, on tech, it's already broken down. I've covered this trend line there. So that's why I suspect tech's not going to take the baton back and take us to new highs. And if it does, guys, then that's just going to be it. And we're probably talking a few more months of upside, new highs in the market, and the media will cheer. Bears will be criticized. There's hardly any bears left. I'm probably the only one out there right now that still thinks we're going to see a big drop in 2026, and I think we're on the precipice of it. I've got other things if I can get to in this video I will, but I promised you it won't be too long. But one of them, my CPCE, put to call equity only ratio, just hit my red zone, which it hasn't done in so long. Again, I'll cue that chart up maybe in another video when I cover sentiment and breadth indicators. Okay, let's move on. I already gave you a thorough update on the Mag 8 this morning. And then on that, before I fully move on, as I said, Microsoft was clearly, without even a close second, the most bullish stock setup in the Mag 8 right now. And I mentioned you can take that as both a indirect hedge or a partial hedge against an index short if you are short the Qs for the reasons I just mentioned. My first target's already been hit. And guys, this is technical analysis. So it is not mere coincidence that Microsoft rallied, so it just others are rallying by sympathy. So what I'm going to show you here real quick is QQQ, right? Here's your Mag 8. I always have this watch list sorted by order of market cap. Top 8 right here, what I call the Mag 8. There's a market capitalization. And it is far from mere coincidence that, in my opinion, the one that's up by far, you have Alphabet's negative or slightly flat, Apple's flat, Amazon's up 2%, Broadcom's negative, Meta's 2, Tesla's flat, Nvidia's 1.6, Microsoft 3.5. So what is that? Triple the average of any stock in the Mag 8 right now. Obviously, and it still has a very significant weighting. It's only the fourth largest, but by a very small margin. It's almost as big as Apple, which is almost as big as Alphabet, which is almost as big as Nvidia. So by taking an indirect hedge now, you would be whatever your portion of QQQ is. Let's say you're short, whatever your number is, whether it's 10,000, 100,000, above that or below that. If you're 10,000 short QQQ, you take a $10,000 long position in Microsoft. QQQ is up 0.57. So now you've tripled that, not tripled, but close to it, in Microsoft, right? That's an indirect hedge. Another way to indirect hedge is, I mentioned this in one of the comments the other day to one of the subscribers, is that TLT, to be long treasuries, which we do have as an active long trade, even though I am partially hoping it fails. I don't have it right now. And part of me hope that, put it out because it's objective. The charts are there. And my logic is that if, here, I'll show it to you. Okay, right here. So Jay McCallum said, really liking the look of the 30-year Treasury bond futures. And yeah, sure. I said, I try to provide something for everyone here. LOL. No, I truly do. Honest to God, I try to, that's what I do too. Keep the charts going, bullish setups, bearish setups. And even when I provide a setup that I put as a bearish setup, like short on the markets, for example, QQQ, I will clearly state the objective levels to buy for somebody long, pullbacks to support, breakouts above resistance. So even in that, I might be taking the trade one way or looking at it going one way, but I will do my best to highlight for those that are bullish or taking the other side of any trade, hey, where it's going to go the other way. So on this one, so look, TLT is right back to where we entered the current long trade after hitting and reversing off the first price target, which is typical. That's why I list multiple targets. You can find that in the FAQ page under resources. And it's still making a marginal new and still divergent low. So this is it. This is yesterday, or I think it was yesterday or the day before. So we bought it here. After shorting it here, shorting it here, I believe, we hit my first, second, third, fourth, and final target. Then we turned around, as I often do. My final target's usually going to be about the end of a run on a move on when I'm swing trading. And then we turned around, we bought it here. We hit my first target, had a pullback as expected. It's been moving, really consolidating between that first target, which is still resistance, made a marginal new, but still divergent low. And as I mentioned in this post, it was right back to where we started. And so you can take this. Now, the key takeaway, what I'm saying here is that right here, let me just read this out, because this is the kind of stuff I've learned over the years, especially now with the market kind of going one way, and Randy, you say this and you have such convictions, but Kramer tells me to buy, that we're going to be a great year, blah, blah, what I do. Well, if you don't know what to do, you shouldn't be in the market. If you don't have enough convictions of your own, read on the charts, whether whatever you're using, fundamental or other services, or your own read, don't force a trade. I've learned that the best trading I ever do is when I learn to sit on my hands when things aren't clear, and then engage aggressively when my convictions are high. That's when most of my money is made. It's made in spurts, at least trading a certain security, be it natural gas, the equity markets, an individual stock. I'll sit back, wait. Bitcoin, crypto, months on end, I won't engage it. And then all of a sudden, I'll maybe start scaling in if I have a kind of see a potential for a turn developing, or I'll aggressively go all into a full position if I see a powerful breakout and I have convictions that we're going to have a strong move. All right, so let me just read this and I'll move on. A long on the 30-year Treasury bond via TLT or ZB can also be referred to what I call an indirect hedge against a short on QQQ, as falling rates, which means bond prices rise, would be net bullish for the stock market. Here, let me use this. Is bothering me, this little AI thing that's popping up on this browser. So again, if you're short QQQ and going long Treasury bonds, falling interest rates, which means TLT will go up, and we'll go ahead to those price targets I gave you. That would be net bullish for the stock market, because your gains in ZB, which is a Treasury bond futures, a 30-year, would offset losses on an NQ short. Now, a little caveat. Let me just add this in here. You have to adjust your position size. Treasuries move up and down a lot less in percentage terms than the stock market. So I typically suggest a 2 to 3 times larger position on a TLT trade versus what you trade on SPY or QQQ, because that's about the offset in beta. In QQQ and SPY on a really big day or big down day, big up or down, usually about 3% is an extreme. You can go up and down more, but those are really big days. And in Treasuries, a 1% move is a big day. So that's how I come up with that lot. It's not very complicated. And again, I've traded these for years, so that's about it, 2 to 3 times. And so basically, if Treasuries drop, so if that trade doesn't work out, it's because yields are rising, and that's going to be a net headwind, which is bearish for the stock market. So therefore, your gains in your QQQ short should be, there are no guarantees, offset by losses on that Treasury trade. So that's an indirect hedge. Now here's the kicker, guys. And we've done this many times in the past on the site with TLT in the market, long or short, either one. If things play out the way I suspect they will, and the stock market continues to fall to my next target on the daily chart on QQQ, which is T2 and the 200-day moving averages, which in turn triggers a flight to safety bid in Treasuries, which it most likely will, meaning institutions sell stocks to rebalance and go into Treasuries, that would result in gains on both trades. So that's a win-win, and that's why I often prefer indirect versus direct hedges on my positions. A direct hedge is if you're short QQQ, you buy calls on QQQ. That's one way to do it. Or I've heard people that will buy short QQQ and then turn around and buy it. That makes no sense to me. Your broker's only one profiting on that trade. It's a direct washout minus your commissions or transaction fees or tax or whatever. So again, if I don't have enough confidence to be in a position, why fully hedge it? I'll just get out of it. There's no reason. I'm only going to be in something if I think it's going to make money. And then I will take those indirect hedges if either if they fit at the time or my confidence isn't high. Okay, with all that being said, this is TYX, the yield of the 30-year Treasury bond. Remember, it moves opposite to TLT. When yields are going up, bond prices are going down, and vice versa. And so this is where TLT, the 30-year is. We broke out of this downtrend line. I believe that's significant. And this is what I call all hell breaks loose in the stock market, my let loose level. These are the previous highs. They're not just the last highs over the last couple years. As I've mentioned many times, there's a double top high in 2023 right there, about October 2023. And then here in middle of 2025. But as I've covered many times, if you go back, this will take the yield on the 30-year bond to levels not seen since the financial crisis and even back in the early 2000s, late 90s. So it's a massive technical level, and I can all but guarantee you it'll be all over the media, and there is no way to spin that as anything but bearish for the stock market. Now, the 30-year is our long bond. It's a lot like Japan now has the 40-year long bond, their ultra long bond. And some people are dismissing that because they're saying it is a relatively small part of their issuance. It might not necessarily break the Bank of Japan. But what I look at here also is the 10-year Treasury, which clearly broke out of this trading range. Taking a little breather now because it was a pretty strong breakup. But as long as it remains above here, especially if it starts to power back up, whether it backtests or not, market's going to start to take note of this. 10 years are the big one to watch as well. And I've even noted down all the way down on the 5-year even broke out. So it's not just about our long-term bonds. We have short-term yields breaking out as well. See the 5-year breaking out of that pattern after the trend line breakout. So this is, if you want to know what may put the brakes on this super duper 2026 year we're supposed to have in the stock market, I'll tell you, this is one thing very, very much on my radar. So continue to monitor it. Enough said. I covered Microsoft. I covered TLT. Now I'm going to wrap this video up with a few updates on trade ideas. I'm going to start with wheat only because I got that out to you today. This is what the daily chart looks like. I got your 60-minute out right there. I had a hand drew it in on the screen capture software. You might have saw in the trade idea. It said R1. R1 means first resistance level. That means we're probably going to get a reaction, which we now already have a reaction. See the little red candle? So we need to pop that, and that's going to increase the odds. We're going to hit my first, second, and then third targets. And I still have longer-term targets and remain longer-term bullish on wheat. Any one of these little 60-minute lows has the potential to be the bottom, just like I've been saying in natural gas, that we keep making these series of 60-minute divergent lows with nice pops and trades. A lot of these lines just disappear. You can see my divergent, that was the last divergent low, but it ended with a divergent high. And again, the long-term charts are very constructive. And so I do believe this has the potential, if we can start popping some of these higher, especially this level right here, and that's T3. So if we take out T3, it's going to increase the odds for a much, much bigger and longer term trade in wheat. All right, AVD, I wanted to point out, because I pointed out the breakout in that one yesterday, the breakout has failed. So I wanted to talk about this trade. I don't like to only talk about winning trades. Let's talk, it's not a loser by any means. I mean, it popped yesterday. First of all, it's been a profitable trade. We hit my first target already, right? Then we put in a divergent high. We hit the trend line. We pulled back. Then I gave you a buy signal here recently on a break of that trend line. And so that alone, if you took that one, was on the last update before yesterday, 24% run from there. So now, here's my thoughts. So yesterday, right after I posted the setup that it needed to break that level, it did break it and it was above it, but then it closed the day back on it. And that is one reason I always say a solid break and or daily close. Didn't get the daily close. It's the opposite of a stick save, if there, whatever term that would be. So we closed back down and we're back below it now. So it's not even a failed breakout, if you will. If you look at it from an intraday perspective, yes, it's a failed breakout. If you look at it, hey, it's a daily chart. You want to solidify the breakout, you have to wait for a daily close. So it's basically another test of the trend line. I just want to say, so at this point, I wouldn't take it. I wouldn't take a position. I did add to my position yesterday. I'm sorry, I had been out of it. I had re-entered this one. And I added, took a position yesterday. But I'm going to hold it. It's not down much, and it's still very constructive. You also want to see this PPO, the white line, the lower signal line cross above. That delineates bull and bear trends. Bearish when the white signal line's below, like that. Bullish when you take it out. So, stops. Well, stops are going to be relative to your price target or targets. I gave you many of those, and you can, set your stop in line where I just wanted to point out that, this pullback today, I love buying pullbacks when I'm bullish or long a stock, pullbacks to support. I absolutely will not buy a pullback that results in a failed breakout. So bottom line, just hold off and wait for either an intraday pop. the next intraday pop above that yesterday's high should do the trick, even if it's early in the day. That's my opinion. Or you wait for a solid close. I just wanted to update that one. Random stuff, just stuff I've been eyeing lately. TNDN, tandem diabetes, coming off a big divergent low. And this one recently took back the 200-day moving averages after failing them here, resistance, and it's back testing the 200 simple with the 200, exponential with the 200 simple below. So anybody looking for a continuation trade can go long here with a stop somewhat below that 200 exponential right there, or the 200 simple, the blue line. What else do I have for you? Netflix, no big update. It's coming up on T1 now. Like I told you before, I added, I made that a first target for anyone who wants to take the quick buck. We've only been in it for a couple of days, and we should hit that unless the market reverses soon. Again, you pick your target or targets. Another one I'm watching, I got an alert on this one today. They just reported PFBC, Preferred Bank of Los Angeles, is cracking below the trend line on earnings. Big primary uptrend line, big negative divergence. This is a regional bank, and I'm very much ready for the next shoe to fall on the KRE, the regional banking sector ETF, looking like a double top and still divergent high. This setup here, these divergences, and there's your uptrend line, forms a wedge. Looks no different from this setup here, and we shorted the regionals there. So regionals are about done, and that's one of my favorites, that PFBC, especially now that earnings are out of the way. So unless that, you can wait for see if you get a daily close if you want to play it safe. You can also wait, probably take a starter position if you get that, and then wait for the regionals KRE to break down below that trend line I gave you. But I've gone through the individually. I'm not going to digress in this video, but I've looked at a lot of the leading regionals, and they're all looking the same. Overbought, big divergences, ready to take the next leg down, in my opinion. And then last but not least, I told you I would talk a little bit about trading on the news. This is NFE. Give you New Fortress back here with a buy signal coming to break above the trend line and or daily close. So there's another example, intraday pop, closed down below it, and then the next day it broke out. So that was our entry point. We're now up 50% on this trade, and T2 has effectively been hit. I always tell you sell slightly below the actual resistance level I give you. We're at 195. That's a 2.5% away from $2. So when I say sell slightly below, it's all relative. If you have a 200-point security, I'll sell 5-10 points below it. If I have a $2 security, 5 cents is close enough for government work. As I said, 2.5%. So there it is, hit. I believe it was. Let me measure it here. The breakout happened right here. It takes us up to here. 57% profit. And here's what I wanted to point out. Trade ideas. Let me make this smaller. Let me fit this screen back in here. Trade ideas, active trade longs, NFE. You can sort these by symbol to find them easier. See what you're looking for. And they're alphabetical. There's NFE. And here's what I wanted to point out. And I promise this is only for the sake of trying to let you into my mindset, how I think, how I've been doing this for a long time. And trading on news, it's almost, if you go against what the news and media and most pundits out there are saying. So when I put the trade out there, Bernadette shared, investing.com, S&P Global just downgraded New Fortress selective default after the company missed a $30.6 million interest payment on its loan that was due on December 10th. Well, okay. I don't think that just came out of the blue. I think I'm pretty sure that at least some analysts were on there and knowing that they were probably. And I don't look at fundamentals on most of the trades I give you guys. I encourage you to do your own due diligence. And I also warn you when stocks are low price and they may have higher risk and risk of bankruptcies. But this is something that was, especially at this point, because it would already happen, priced in. And so when all the bad news is priced into a stock, there's nothing left but good news. All the weekended longs have been shaken out. Either way, take it, don't take it. 57%. If you're happy with that, walk away. If you are going for the prize, what I call it, the final targets, just set your stop. At this point, it would be insane not to have a stop at least at break even to assure that you don't lose anything. Now remember, when you're threading the needle and you're playing around with pennies or not penny stocks, I told you before, it was, they will come in and defend that $1 level with their life. I'm talking the insiders, the owners of the company, the insiders, executives with insider buying, reverse splits, any kind of manipulation they can, because they don't want to face a delisting. So stocks will often very aggressively defend that $1 level. But you're still in the realm where this guy could come out tomorrow and declare bankruptcy. And then boom, it could open down at 30 cents. Okay. And it's going to blow past your stop. So if you're playing down in this area of the sandbox, just know that. And you don't have to. And I believe I said it at the time, and I say it often on these low price trades. I'm not a penny stocker. I don't pump and dump. I never front run anything. I share what I see. I take the same breakout points that I tell you. Sometimes I'll take a position early if I think it's going to break out before it even does, but I'll usually let you know. But my point is, these are the guys that have a higher risk. And as I believe I said at the time, you don't have to put a lot of money in a stock to make, if you hit my final target, it's going to be almost 140% run. So you can put a fraction of what you might normally put in SPY or QQQ or Apple or Amazon. If your number, let's just say your number is $10,000 usually on a stock trade, you could put in $2,000-$3,000. You're still going to make more money in this trade in absolute dollar terms than you would on a successful Amazon or Apple trade where you're trying to make 10%, right? Because of the much larger profit potential. And it cuts both ways, guys. The one, I give you a few guarantees. And this is one guarantee I used. The only guarantee I gave is when I was a stockbroker, financial advisor, is risk and return go hand in hand. There's no free lunch. You look at the stock paying a 15% dividend yield, there is risk. You don't know it. You don't see it. If you dig enough in the fundamentals, they're using leverage to enhance that yield. Their cash flow is very questionable. And so you're chasing a 15% yield, and one day they can just cut that dividend or eliminate it, and the bottom will fall out of the stock. Same thing when you're playing around in this area of the sandbox, these little low-price stocks. The returns are powerful if you get it right, but they can fall just as fast, and they can do so via a gap down that blows past even the best place stop. So I'm going to end it there. That's kind of, I always try to do this because I just, I don't share in your losses. I don't share in your gains, but I do feel horrible when somebody takes a trade and I realize either they took a trade that they didn't have a stop on. They've just stuck with it and it goes against them, or one of these type that pop down. Obviously I hope everyone everyone profits and we don't ever get those, but you trade long enough, you're going to get into a stock that just starts out looking great like this and then boom, right? But again, the way to mitigate that is spread your bets and put smaller dollar amounts in these type of what I call Vegas trades, gunslinger trades, because it doesn't take a lot of money to make a buck if you're targeting 100, right now almost a 60% up to about 150% profit. All right, I'm going to stop it here. We'll watch, see how the market closes today. Unless it has a big reversal or a big up, it's probably going to kind of end the day or the week, I should say, about where I started this morning with those Mag 8s. Like I said, Microsoft, let's see if that breakout sticks. We already hit the first target. Like I said, I'm kind of preferring a sweet spot on Microsoft as a run back to the 200s. But remember, we have more check marks. Check marks, bearish check marks on the Mag 8 than I do those red X's, meaning that they haven't broken down yet. So therefore, take this with a grain of salt. It was technically induced. I don't care if there was a headline on Microsoft today. I do not care if it was a headline that justified. In fact, the media will come and cite something. But I can just tell you that's the first resistance, second, and third. So this is my bounce target range. We're already at the minimum. And so that opens the door for a reversal now, here, or here. And if Microsoft does this, it's probably going to hold up the NASDAQ 100 into next week, right? And if it reverses here today, especially into the close, again, we'll see. All right, let's just see where it goes. But again, the rest of them are just Most of them are just following in sympathy today. And actually, the biggest one, remember, the holdout, the best in breed, best in class lately has been Alphabet. Look at Alphabet. Remember, we broke down yesterday. I'm sorry, right here to Tuesday. Made a back test from below, parked right below the trend line on Wednesday. Tried to regain it. Remember, I updated this one in the morning for you and told you it was above, but it would, if it faded, it would close back down on. That's not a recovery of a trend line. You close parked on it, and now we're back testing for the third day in a row. So far, it's down, with the Nasdaq 100 being up. So when you kill the final leaders, I have enough. I have a lot of check marks, enough to be short. Not aggressively short till I get them all, till I get the next ones. But this is a start. And again, this is a little micro analysis. We could close the day back on there again, and then it'll just be to be continued next week. I just wanted to point that out, that this one's following through on the selling. And again, this is, not sector rotation within the Mag 8. Finally the Alphabet's starting to show some weakness, and what are they doing? Exactly what I figured they do. They come in and buy the most beat down ones. Microsoft had the best looking chart. Alphabet's off all-time highs, and Microsoft's down 21%. This is a no-brainer. It's a hedge. It's a directional hedge. It's long Microsoft, because the odds of a short covering rally bear market bounce are high, and short the rest of them. All right, I'm going to stop here. This has been Randy Finney with Right Side of the Chart. Have a great day.